Bit lackluster today. Why? Because we have all those debt concerns over Europe that Steve was talking about, and of course fiscal problems, talk of fiscal problems over in the US, and of course tightening concerns over in China. That seems to be weighing on sentiment. In terms of Nikkei 225, that seems to be outperforming the region today in line with what's happening with the overall markets, up 0.9%. Why? Because of the softer yen and the stronger dollar, up to 7-month highs. The Hang Seng and the China market pulling back a little bit because of rate tightening concerns. Lots of talk about the PBOC tightening this weekend. Why? Because the China shifted the key economic data, the release of key economic data, to Saturday instead of Monday, so spurring a lot of talk about imminent hike this weekend. Elsewhere in South Korea, the Kospi down 0.4%. Geopolitics once again weigh on the market. The Australian market down 0.6%, and the Bombay sensitive down 1.2%. In terms of dollar rates, we're seeing a broad dollar gains across the board there. Dollar yen looking like this: 83.90, euro dollar 1.3226, sterling dollar 1.5720, and euro sterling 0.8413. So, you know, that strong dollar really is making it a little bit unattractive for me to visit you right now, Nicole.
Oh, well, I will take care of that. We will take good care of you when you do come, Christine. Meanwhile, speaking of that dollar play, an advisor to the PBOC says the U.S. dollar will be safe for as long as markets are focused on the turmoil across the pond. But he also says that the U.S. is in worse fiscal health than Europe. So assuming the worst, how do investors position themselves? Joining us now to continue the conversation, Gareth Ferry, CEO of Market Tamer, and still with us, our guest host, Gary Burnison, CEO of Korn Ferry International. Thank you so much, Gareth, for being with us. So how do investors position themselves in regards to all of the headwinds I just mentioned?
Well, good morning, Nicole. I think certainly in the short term, as we're looking at the market, it's hitting resistance right around 1235 on the S&P. We're seeing support right around 1170. So in the short term, we really don't see tremendous opportunity either for longs or shorts. We do see great opportunities for options traders at this point in time. If we stay range bound, there are certainly creative ways to take advantage of that range bound market through to the end of the year.
Now, we're also hitting some key technical levels in terms of bonds, and of course what was going on yesterday, all eyes are going to be on the 10-year auction that's coming out at 1 p.m. today. Is this an incredible shrinking rally, as Art Cashin, who's of course the floor director at UBS, put it?
You know, as we look to the market, we're looking at symbols such as TBT, which basically plays the inverse of the bond prices, and we're already seeing that up about 25% or so over the past few months. So longer term, we expect that to continue. In the short term, it's very hard to pick the inflection point, and so as we're looking at taking advantage of that, we think longer-term long call options are a great way to go.
Yes,
but in the short term, you can always pay yourself back with shorter-term short call options.
Gareth, it's Gary here. What's your take on the growing talk about the muni debt crisis here in the United States? You know, with 47 out of 50 states underwater.
Yeah, I think that plays into just a larger theme that there's tremendous uncertainty out there. You know, even if we were looking just last week at the jobs data, the expectations were far more positive than it actually turned out to be. So from our perspective, we think that going long equities only, in spite of all the supporting mechanisms, the low interest rates, strong corporate balance sheets, and so forth, we think it's really smart for traders to actually hedge themselves in this market, given that level of uncertainty that's out there right now.
Gareth, spent a lot of time looking at the options markets over the last 20-odd years, and one thing I've always worried about is telling retail investors to get involved in call spread strategies, long call spread strategies, because unless you get some decent gamma movement to the upside, a bit of an uptick in the Vega, you're going to suffer unless you hit that 120 strike, which is what you're advocating on one of your trades here. Are you worried, though, that you're encouraging people to get involved in strategies which have such a large amount of decay? It's gone.
Well, actually, if we were looking long-term on the markets, one of the strategies we really like, which I think you're looking at, is a 110, 120 bull call spread in the money on the S&P 500 SPDR. And actually, time decay is a great advantage for that trade. We're looking at it out to December 2011. And essentially what it means is no movement is needed in the markets right now to the upside. So certainly some analysts have come out predicting a very bullish market next year based on the third year of the presidential cycle. But even if that does not materialize, even if the market stays flat, or even if there's a slight decline over the next year, that spread trade still works out. So I think it depends on how you structure the trade. If you're requiring movement, then certainly I think your points are absolutely fair. In this case, we were looking at a creative play where the market does not have to move in order for the trade to profit.
Well, what's your view on the broader VIX at the moment as well? We all know traditionally when the market's really in panic mode, we see the VIX picking up on the downside, we see the skew picking up on the downside, so the out-of-the-money options all start picking up. But if we are looking at a broader market recovery, do you think the VIX is now down at levels actually where our viewers can still make money out of a premium strategy?
Sure. I think that obviously as we start to see the VIX start to decline further and further and complacency increase, it becomes ever more difficult to take the premiums out of the market. But if you're looking at going in the money on some plays so that you're actually taking advantage of the maximum premium at the money or close to at the money with the short options, there's still tremendous ways to take advantage of the market even in spite of a lower VIX.
All right, and we'll continue that conversation as to how to take advantage of this market. Gareth Ferry, CEO of Market Tamer, stays with us for the rest of the hour. Gary Burnison, CEO of Korn Ferry International, no relation there. Still much more to come. Why do these people, take a look at this, take all their money out of their bank accounts in France yesterday? And which sporting celebrity was behind it? We'll tell you out of the break. Welcome back to Worldwide Exchange. Costco reporting first quarter results earlier this morning. The Members Club warehouse operator earning 71 cents a share, topping forecasts there. Same-store sales rose 7%, fueled by 14% growth in Europe. Comps rose 5% in the United States. Analysts had been noting a recent swing to the upside in TV sales and continued strength in food. Let's take a peek at Costco, up almost 2%. Meanwhile, Fortune Brands reportedly plans to split up the company into 3 separate businesses under a proposal approved by the board. The Wall Street Journal says that Fortune will have its spin-off, its unit, home and security, I should say, which makes Master Lock and Moen Faucets to the shareholders. It will also spin off or sell its golf business, which includes Titleist and FootJoy. That will leave the company to focus on its liquor brands like Jim Beam and Maker's Mark. Fortune Brands, let's take a peek at how Fortune is doing, up almost 3.5%. Christine.
Nicole, fresh data out of Japan today pointed to an economy still stuck in a flat growth track. October's current account surplus rose much less than many had hoped, while core machinery orders slipped worse than expected. Japanese Economic Minister Banri Kaeda today expressed pessimism about the country's growth rate. He predicts a sharp contraction in the October to December period. But bad signals aside, Japanese markets managed to touch 7-month highs today, backed by the weaker yen. Steve.
Right, he's a legend in the red half of Manchester, a second-tier French actor and now a major critic of the banking industry. Eric Cantona, the former Maverick footballer known for kung fu kicking supporters, or just the one I think it was, had called on people across the world to withdraw cash from the corrupt and criminal banking industry. His quote, not mine. Despite some small protests in France yesterday afternoon, there has yet to be a major run on the banks. Nicole, you a big fan of Eric Cantona?
I have no idea what you're talking about.
She's getting a fish pedicure. She's got the cotter down here with her feet right now, Steve. So she's totally distracted.
There's a cultural difference. Can you just explain really briefly?
Right, Malcolm Glazer.
I'm not alone here. Gary doesn't know what's going on right now.
Malcolm Glazer, the Tampa Bay Buccaneers chap, who also owns Manchester United. He bought a little club called Manchester United. It's probably one of the top 3 clubs in the world.
Yeah,
their former superstar midfielder was Eric Cantona before he owned them. But now he's dabbling in politics, it seems, and anti-banking industry initiatives. Natural progression from Man U midfielder.
Of course. It's all a good sport. All right, continuing on the good sport. You've been such a good sport this entire hour up at the crack of dawn. I don't even think dawn has broke yet.
It has not broken.
It's 5:45 on the east coast of the United States. Pulse check on jobs, though, and we dug into your numbers that came out earlier today, beating estimates by and large. But there's still some struggle that you are looking at in Europe. What do you think is the biggest headwind facing CEOs from what you're hearing from your clients today?
Well, I think that, look, you had this tremendous storm, and it was severe. Starting 2 years ago. And, once the storm is over, you kind of look around and you say, what's the new normal? And so people are, they remember the way it was 2 years ago. And the truth is there were many businesses that went out of business, right? And there was a great run for liquidity. So as a CEO, you're going to be cautious. I mean, our business right now, we are almost at the peak where we were 2 years ago. We've outperformed the industry at Korn Ferry. But we've got 22% fewer employees. And, I lead a business that's in 40 countries around the world. And we're going to be cautious.
So you're not hiring?
We're selectively hiring. We are investing in the business. But we're careful.
Okay, careful is fine, but I have CEOs like you come on all the time and sit in that exact chair and say, we need more certainty, we need more certainty, we need more certainty. So yesterday it seemed like we had more certainty in terms of tax policy with the extension of Bush-era tax cuts. Is that enough certainty? When are you going to get to a point where the certainty is good enough that you can start hiring and you can put your money where your mouth is?
No, that's not going to be the certainty. The certainty is demand. There needs to be, again, it's this virtuous circle or vicious cycle, depending on how you want to look at it. Again, out of income comes spending, out of spending comes jobs, out of jobs, comes more spending, right? And the truth is, if you look around many economies around the world, people are hurting. And here in the United States, if you look at 30% of the households, there's one person looking for a job. In this country, we haven't created jobs in a decade. We're a country that is spending $4 for every 3 we get in, right? So there are significant issues. We have overspent as a country over the last 20 years, and that has to be dealt with.
All right, well, we'll try to deal with that and figure out if it's a virtuous or vicious cycle. Coming up, Gary sticks around for the rest of the hour. If you have any questions for him, email us at worldwide@cnbc.com. Coming up, the S&P was up 0.05% yesterday, almost as flat as a pancake right there. So if the tax cuts affect petering out for the markets yesterday, will that continue today? We'll look ahead to the trading day on Wall Street coming up in just a bit.
And as you look at, look at the Dow, the S&P, I mean, what do you think for next year? I mean, what's your call?
For next year, long term, we really believe that interest rates are going to remain low, so we subscribe to that consensus view. We think corporate balance sheets and margins are going to improve. That will translate into higher earnings figures. So ultimately, we believe that will translate into a positive year for the S&P 500 next year. But as always, the way we like to play the market is to hedge so that even if our expectations are not met, that there are ways to mitigate risk to the downside and hedge positions just in case the movement to the upside doesn't materialize.
Yeah, well, that, Nicole, Garrett, that is the good news. Companies in the United States have never had as much cash. I mean, we're talking American businesses over $3 trillion of cash.
Are you spending the cash?
eventually that will happen. Absolutely.
Are you going to repatriate the cash is the other question.
We have repatriated cash, and we've made 3 acquisitions, and we'll continue to accelerate through the turn, and other CEOs will do the same thing.
Gareth, Gary broke some good earnings this morning. Are you buying Korn Ferry?
At this point in time, Korn Ferry isn't in the universe of stocks that we're looking at, but absolutely we'll be looking at it right after this segment.
There
you go. That's exactly right, Gareth. That's what we like to hear.
All right, Gareth and Gary, thank you so much, gentlemen. I'm sorry about the slip-up. Gareth Ferry, CEO of Market Tamer, Gary Burnison, CEO of Korn Ferry. Thank you so much for being with us for the entire hour. Let's take a quick peek at how U.S. equity markets are likely to open. Dow futures are off about 20 below fair value. NASDAQ futures and S&P 500 futures are